What we're going to be covering in this video is level term life insurance. There are a few different forms of term life insurance. However, this is most commonly known and understood form of term life insurance. Most people have a very good general understanding of how this works, and there really isn't much to it. For this example and for the examples that I will be using in the videos to come after this, all of the examples will be a healthy male, age 45, and I'm going to be using a preferred rating. Preferred rating is the second highest rating one could receive. Preferred plus is higher than that, and then once you get below preferred, you have standard, select, and then you have tobacco ratings and even substandard ratings below that. The higher the rating that you get, the lower that the premium will be. So in this first slide, and I will be going through two separate slides in this video, this first slide is just going to simply show what the cost of the premium would be for 20 years for that same 45-year-old male to have $1 million of death benefit in force. The second slide that I will bring up will be using the same male, age 45. However, you'll be able to look at different time frames for a term. As an example, maybe a 10-year, 15, 20, or 30, and how that affects the cost of the premium. And then we can also look at different ages and how that affects the premium. Obviously, the younger that you are, the cheaper that the premiums will be because your likelihood of death is low compared to someone who is older. That's essentially how the insurance company calculates the premiums. So in this slide, very simple, right? You have year, age, annualized contract premium, and then your guaranteed death benefit. So this is an annualized premium amount. So if you divide that by 12, you get $100 per month. So you can pay this premium monthly, quarterly, semi-annually, or annually. Most people choose to just have the premium to be paid monthly. Okay, so in this case, it would be $100 per month to have $1 million of death benefit in force. As long as this individual is paying this premium, this death benefit is guaranteed, and it will be for 20 years. Now, after the 20 years is up, most people will cancel the policy because the premium jumps up significantly, right? So they'll get a bill for that higher premium. They will not pay it. The policy will be done. They will have no more life insurance. So the only downside to term life insurance is all of these premiums that you are paying to the insurance company over the time frame is going to the insurance company. You're not building up any cash value, anything like that. So if you do not pass away within this time frame and you get to year 21, all these premiums are with the insurance company and you no longer have that $1 million of coverage. So to verify the cost of the premium that we just viewed on the healthy 45-year-old male using a preferred rating, you can see highlighted right here that the premium annually is $1,200, which lines up with the slide that we just previously viewed. And you can also see that is a $1 million face amount. The face amount is the death benefit, and also that we did use a male. So these numbers line up. So what's really cool about this slide is you can see that there's different level term periods. You have a 10-year, 15-year, 20-year, and 30-year. And like I stated previously, the longer that the term is in force, the more expensive that the premium will be. And also the older that you are, the more expensive that the premium will be. The reason why that is because the insurance companies very meticulously calculate and understand and know, based off of historical data, the likelihood of when people will die. So obviously, the older you are, more likely that you will pass away sooner than later. That's how it's calculated. So as an example, let's look at that same 45-year-old male and using a 15-year term policy. You can see that the premium is going to be lower because it's only in force for 15 years. Going to a 10-year, same thing. Premium drops to $670 a year. And then you go to a 30-year, right? It's much more. So all of these numbers are calculated the same way using an age and a time frame and a rating. Those are the three factors on how the premium is calculated. So again, just to recap, you have 10-year, 15, 20, or 30-year terms. You have an age and you have a rating. So these are the ratings: preferred plus, preferred, select, standard, and like I also stated, there are tobacco ratings and substandard ratings below that. You can imagine that those premiums get very expensive the lower that the rating is. So most people get the preferred rating. I do have many clients who get a preferred plus rating, and most people that have a preferred plus rating are typically not required to even get an exam. So they look at your height, weight, medication that you're on, things of that nature to determine if you need an exam or not. If you do, you could still get a preferred plus rating, but that's how it's calculated, very simply put. Okay, so this concludes video 1, where we've gone through the basics of level term insurance. There are other forms of term insurance that we will not get into at this time, but this is, again, the most commonly known form of term life insurance. Please stay tuned for video number 2, where we will dive into permanent life insurance. Thank you so much.